Have you ever looked at the massive growth in big tech stocks and just thought, man, that's great, but how do I get a paycheck from that? Well, if you have, then this explainer is for you. We are diving deep into an ETF called QQQI, which is built to do exactly that. Try to turn the Nasdaq 100 into a source of high monthly income.
So here's the game plan. First, we'll talk about that big, juicy paycheck promise. Then, we're going to pop the hood and see how the income engine actually works. We'll also uncover a really unique tax angle that you need to know about, get real about the trade-offs, and finally, see how it stacks up against the competition to help you figure out if this is a good fit for you.
All right, first things first. Let's talk about the headline, the big promise that gets everyone to turn their heads. What exactly is this big tech paycheck that makes an ETF like QQQI so interesting? Let's just start with the number that stops people in their tracks, okay? As of late July 2025, QQQI was showing a distribution rate of 14.56%. That is a huge number. But, and this is really important, you have to remember this is a snapshot in time. It's what happened in the past. It is absolutely not a guarantee of the future.
Yeah, so when you see a number like that from stocks that are famous for growth, not for paying out big dividends, the immediate question is, how on earth is that even possible? How do you squeeze that much cash out of the Nasdaq? Let's get into it.
So here's the secret. QQQI isn't just buying and holding stocks. It's an actively managed fund that's playing two games at once. Part one, it owns the big tech leaders you know, your Microsofts, your Amazons, your Nvidias. But then part two, it layers a sophisticated options strategy right on top of that. And that is the engine that's designed to crank out those high monthly payments.
So, how does that income engine actually run? Let's pop the hood and really take a look at the mechanics that are powering these big distributions.
At its heart, the strategy is a pretty simple one-two punch. Step one, you own the stocks, right? That gives you direct exposure to all that big tech growth potential. Step two is where the magic happens. They run a systematic option strategy on top to generate cash flow from that portfolio.
Now, the specific tool they're using here is called an index call spread. And don't worry, you don't need to be an options guru to get this. Just think of it like this. They get paid cash today in exchange for agreeing to cap some of their potential future gains. But, and this is the key difference from other strategies, it's designed to still let you capture some of the upside if the market really takes off. It's a way to get paid now without giving away the entire store.
Okay, now we get to what the source material called the sleeper advantage. Seriously, beyond the high yield, this is what could really set this fund apart, especially if you're investing in a regular brokerage account. This is a critical detail.
And here's the big payoff. Because QQQI uses options on a broad market index, the profits it generates can get special tax treatment under something called Section 1256. So what does that mean for you? The bottom line is that a huge chunk of those gains, 60% of them, are taxed at the much lower long-term capital gains rate. For a lot of investors, that could mean keeping way more of that income after Uncle Sam takes his cut.
And it doesn't stop there. Often, a big piece of QQQI's monthly payout is classified as a return of capital. The easiest way to think about this is like getting a partial refund on what you originally paid for your shares. You don't pay income tax on a refund, right? Instead, it just lowers your official purchase price, which means you get to defer paying the taxes on that portion until you actually decide to sell. It's a really powerful tool for improving your after-tax cash flow right now.
Okay, we have to talk about this. This is incredibly important. To get that high income, you have to give something else up. There is absolutely 100% no free lunch in the world of investing. So let's be crystal clear about the trade-offs here. So when can a strategy like this underperform? Well, first, in a face-ripping bull market. If the Nasdaq goes to the moon, QQI will likely lag behind because its upside is capped. Second, if the market gets really calm and volatility dries up, those option premiums it collects will get smaller, and so will the income. And finally, in a sharp downturn, you have to remember, you still own the stocks. The fund's value is going to fall. That income helps cushion the blow. It doesn't make you immune to it. So to make this income promise a little less abstract, let's just run a quick hypothetical. Imagine for a second you invested a nice round number, say $100,000. Well, using that 14.56% rate we saw from back in July 2025, that $100,000 investment would have kicked off roughly $1,213 per month in cash. Now, let me say this again because it's so important. This is not a promise. That number is based on past data, and it will absolutely change from month to month. But it does help put the potential into perspective.
Now, as you probably know, QQQI is not the only game in town when it comes to high-income ETFs. So how does its specific approach compare to some of the other popular kids on the block? Let's see how it stacks up.
So let's line them up. You can think of it like a spectrum. On one end, you've got something like QYLD, which is really built for maximum premium generation, but it caps almost all of the stock market's upside. Then you've got JEPQ, which tries to find a nice balance between income and lower volatility. QQQI kind of carves out its own niche with that specific call spread strategy, aiming to keep a little more upside in the tank and, most importantly, leveraging that unique Section 1256 tax advantage we just talked about.
So we've broken it all down, the good, the bad, the trade-offs, and now we get to the final and, frankly, the only question that matters. Is an ETF like QQQI actually right for you and your portfolio?
Based on the analysis, this strategy could be a really good fit if you're someone who puts income first but still wants to be invested in those big tech leaders. It's especially interesting if you're investing in a taxable account where that tax efficiency really shines. Or maybe you're a retiree who's looking for a steady stream of cash flow from your stocks.
But let's be really clear about who this is probably not for. If your number one goal is to capture every last bit of upside from the Nasdaq, this isn't the fund for you. If you need super predictable, bond-like payments that never change, the income here is going to vary too much. And, well, this one's obvious, but if your goal is to get away from big tech, this is the exact opposite of what you want.
You know, when you boil it all down, this one quote from the source material just says it all. The whole point of this strategy is to take the natural ups and downs, the energy of the tech sector, and try to transform it into a regular, spendable paycheck. And that brings us to the final question, the one you have to ask yourself. Because this is the fundamental deal you are making with a fund like this. Are you, personally, willing to trade away some of that potential for explosive, rip-your-face-off growth in exchange for the chance to get a steady paycheck deposited in your account month after month? Your answer to that question will tell you everything you need to know.